Hey friends, I am back with another episode of Making Sense of Your Markets. I've taken a few weeks off. I've been fishing with my son. It's salmon fishing in the Puget Sound. So I've been out on the weekends doing that with him. But I got a little feedback. So I send this video out to about 300 of my top clients and real estate professionals, builders, and financial planners that I work with. And so I was doing these weekly, and I was getting a little bit of feedback that maybe the messages were great. People were listening to them, but they might have been getting a little bit diluted. So I'm going to probably do one a month or one or two a month, depending on the news. But there's been a lot that's happened over the last month. So if you're a client of mine that is going through the mortgage process right now, you've probably heard this. If you're a past client of mine or a real estate professional, this is going to be great info for you to know and to digest here as we navigate and we jump into August. So real quickly, 30-year fixed rates week over week. It's really weird right now. They were down, they were up, and now they're up again. So we're talking, again, 6.9 to 7.125. This is not a rate quote. It's just a range. I still think they're high. They're high. And the number one thing that I'm seeing right now in the market, well, there's two things that I want to talk about today. The multiple offer situation that we've seen over the last basically 5 years, it's still here. If a home is priced right in a more trending community, for example, last week, Bothell, just your average two-story house listed at $997 went for 1.2. It was from a colleague of mine that I saw share on social media. We are seeing this with our clients in the suburbs of Seattle, mainly in King County, like I just mentioned, Bothell, Mill Creek, Kirkland, Shoreline, Mount Lake Terrace, Linwood areas, and also on the other side of Seattle in the Tacoma Federal Way areas. And so I tell you this because if a home is priced right, there's such little inventory right now. You're seeing multiple offers because there are so many home buyers on the sidelines that want to buy. Now, the other side of this is high interest rates right now. And I'm going to tell you this, I haven't seen this in 15 years in the mortgage industry where we've seen really high interest rates, but we've also seen a very competitive housing market. Okay, normally you have high interest rates and it slows down the housing market. That's not the case because we have a demand of people that want to buy and a lack of supply, a lack of homes. And so this brings me to the number one question that I'm getting asked right now. Dan, what do you think about the housing market? Is it on the brink of a bubble? I don't think it is because we're seeing so much interest in housing with high interest rates. So there's my answer, and that's strictly backed by data. So as interest rates come down in 2024, which they will, I'm not predicting when, I'm predicting that they will, you're going to see even more movement into the housing market. You're going to see even more appreciation as home affordability comes down for people. So I think it's worth discussing right now because that's the number one question and concern that I'm getting asked by home buyers and even real estate agents. Now, what's got me really concerned right now is I saw a stat the other day for credit card debt in America. So Q2's numbers just came out, and we've now broken the $1 trillion mark in credit card consumer debt in America. This isn't mortgages, not even necessarily auto loans. I'm talking about credit card debt. This is not a good thing. This is higher than it's ever been in the United States of America. And what this is telling me, and I've been talking about this for 2 or 3 years, that's why I created this page, budgetwithdan.com, because I truly care about helping people budget financially and becoming more financially literate. So as consumer credit card debt breaks $1 trillion in America, what we're seeing Americans trying to maintain the lifestyle that they've had over the last 5 or 6 years in a high inflationary market. So inflation, remember, the government is raising rates to bring down inflation. They want Americans to run out of spending money. That's exactly what they're doing. They've been doing this since the beginning of them kind of managing our monetary policy in America. They want Americans to stop spending money. They want Americans to run out of money. What they're doing is they're forcing Americans out of money, but Americans are using their credit cards to maintain their pre-existing lifestyle. I've been saying this for 3 years. Stop spending money, Americans. The sooner you stop spending money, the sooner we'll be out of this high inflationary market. So let's go back to data. I want to come full circle with this here as I wrap up. The Fed raises the Fed rate. They have raised it out of control, higher than it's been in the last 50 years, okay? So the Fed raises the Fed rate, so it makes the cost of borrowing money more expensive, so that Americans stop financing or spending money. So then also groceries, gas, travel, that becomes more expensive. So they stop spending their cash. They stop financing stuff and they stop spending their cash. It'll get to a point where we will, and we're getting there, okay? That could push us and will push us into a recession. When that happens, rates will come down. So people are like, how do you know that rates are going to come down? I studied data. I'm going to put this up on the screen right now, and you can see this, the Fed rate, mortgage rates, inflation, and home values. Since 1970, as the Fed stops raising the Fed rate, look what happens to mortgage rates. Mortgage rates come down. So guys, we're going to see high mortgage rates, and we're going to see high interest rates until the Fed stops raising the Fed funds rate, and then it'll probably be about a quarter after we'll start seeing a decline in interest rates. So there's some relief on the way, but the moral of the story today, don't use your credit card to finance your lifestyle. Okay, what we need to do is stop using our credit cards. Use your credit cards for emergencies.Use your credit cards and pay them off every single month. But if you're one of those Americans that is maxing out your credit card interest rate is going to be anywhere between 12 and 20%. That's ugly. That will force you into some financial difficulties. Stop doing that. Don't do that. Now, I want to offer help for you. 2 ways. If you don't want to reach out to me, that's fine. Just go to budgetwithdan.com. There's a 10-minute video there how I teach budgeting, and then there's some information there so I can help you start budgeting and get you on the track to increasing your financial literacy. Number 2, I don't care if it's not mortgage related. Of course, I'm a mortgage loan officer. I love helping people finance real estate. If you have any questions regarding credit card debt or a financial situation you're in where I can help you, I want to be a resource. If you found yourself in a situation where you have a high amount of credit card debt, I can introduce you to a local bank that offers a HELOC where we may be able to consolidate some of that until you're in a position to be able to refinance your mortgage. I don't really like seeing people pull money out of their home equity to pay off debt, but sometimes it's the only option. If you have any questions on that, I want you to reach out. This was a little bit longer today, but if you have any questions on any of this stuff, holler at me. I'm here to be a resource. Have a great rest of your August and a great rest of your summer, and I'm here if you need me, okay? Bye for now.